your cinema room, your viewing room for this conference today. I think that's the coolest thing ever. It makes me smile. So we have been talking this morning with Mike Harrington and Jeremy Gall, and then with Simon Lehman and Cliff Johnson. We looked at data from Jason. We heard from Thibault in Amsterdam. Then we sat down with Bob Milne at Vacasa and JB at Turnkey and Tobias at Oyo, which was a super interesting conversation. But a lot of the discussion has been about the acquisition environment and the fact that there are some companies in this timeline that need to be looking at a different, maybe a different exit plan at this stage. So that's why we invited Ben Edwards to speak today. So Ben, welcome. First of all, thank you for being here. I really appreciate it. Are you able to hear us?
Yeah, thank you. Yeah, thank you for having me.
Yeah, I'm glad you're here. I think that what we've been hearing is that maybe some people that were thinking about exiting the business in maybe 12, 24 months, maybe looking at pushing that timeline up. I think, first of all, are there still buyers?
Yeah, of course. I mean, you know, there's still buyers, but you know, and I'll go into this in the slide a little bit, but the buy sell, the M&A activity through the second half of 2019 slowed down a little bit, and it's not, you know, it wasn't predicated on, well, there not being buyers. It was solely as a result of everyone making too much money in their business. You know, we try to coach folks to sell at their peak, but you know, we were on this run and everybody was making money and life was good, and it's difficult to sell your business when you get that amount of cash flow going through it.
Well, I'll let you get started. I'm going to be fielding questions. If you have questions, you can actually type them into your GoToWebinar screen, and I know that Ben will be happy to answer them. So I'm gonna mute myself and take my camera off, and everybody's sick of seeing me, and let you get to it. Thank you, Ben.
All right, my pleasure. Thanks, Amy. All right, folks. So we've got just under an hour to run through about 15 slides. All of this information will be shared post session here. So don't worry about writing anything down. Just listen to me, hear me, think through what it is I'm saying, because I think it's important information relative to you navigating some of these you know, pitfalls, uncharted waters, and positioning your business in a post-pandemic world. But just to kick it off, let me tell you a little bit about me and why I'm up here. I've got 20 years in the vacation rental business, and my phone needs to be muted. I apologize. 20 years in the vacation rental management business. I've owned and operated 13 different companies of my own. Right now, I have a few different vacation rental companies and a long-term rental company. In the aggregate, I personally manage about 700, 800 properties. I guess closer to 800 properties. Through my time, you know, with various companies and with my companies, I've operated in more than 200 different resort markets. I've run 2 companies larger than 2,000 units, and we've been involved in more than 100 purchase and sale transactions. Very proud of my time with the VRMA. One of the vacation rental businesses we own is Sanctuary Vacation Rentals. Another one is Cinnamon Shore in Port Aransas. I have about 475 units under management on the long-term side that I own in the Panhandle area, and then I do a lot of business consulting, and then I facilitate a lot of buy-sell transactions through you know, my contacts over the years, and primarily almost solely in the vacation rental space. So let's get started. So from an introductory period, let's talk about life pre-COVID, right? Let's talk about the fact that, you know, we're mainstream lodging accommodations. Everybody knows who we are. There's 100,000 plus companies worldwide. It's estimated there's more than 20,000 in the U.S. I think if you spend 5 minutes on the internet, you can find whatever number you want relative to the size of the industry. But there's a lot of us, right? There's a lot of us in the world. There's a lot of us in the U.S. And fundamentally, business growth was on the rise. We were seeing new businesses pop up left and right because there was no barrier to entry, right? All you got to do is hang a shingle out there, say I'm a property manager, I'm a vacation rental manager, get a couple of listings, and that's it. You're off to the races. So revenue was really a given, right? I mean, revenue was given a given simply because the market was on such a bullish tear. So there was a tremendous amount of growth in both occupancy and rate for vacation rental managers. Whether you were a new company starting out or whether you're an older company, you felt like what you were doing was working, but in certain cases, I think you may have had a false positive relative to the economy bolstering your business and you not seeing the underlying cracks perhaps in your infrastructure. So as we continue, we saw, and I mentioned this to Amy, through the second half of 2019, the purchase and sale transactions started slowing. And it's not due to lack of interest, but it's because businesses were doing so well. There were some strong earnings. When COVID hit, from I guess end of January to middle of March, we lost 4 transactions, nearly $20 million in sales. So that would tell you that there are buyers out there. There are people that want to buy your business, but frankly, there just weren't enough sellers. There weren't enough sellers, and the market as it was kind of forced everybody to be a little picky. Everybody was really dug in on what they wanted and what have you, because there'd been such a free-for-all prior to this slowdown, that everyone had a very well-defined investment model. So everything had to fit in a nice, neat little box, and I think all of that really combined drove a slowdown in the M&A activity. That said, people buy vacation rental businesses because of the underlying fundamentals. They're relatively stable ventures. If you know how to run a business, progressively in the right way, if you value relationships, you value service, you know how to make a meaningful profit in your business, it's a great opportunity, and there's room to grow. And there's an ability to grow quickly too. If you want to hammer down and grow quickly, you can be more aggressive. In doing so, not only growing organically in your business, but also this purchase and sale model allows you to grow quickly as well, because the transactions themselves and the transitions are more efficient than they were when I was working on them in 2000 for ResortQuest. There's a number of sizable returns that derive from a vacation rental business. If you buy a business on a 4 to 5 times multiple, that's a return of 20 to 25% for each dollar invested. That said, business combinations create increased margin. You, in a lot of cases, don't have to have 4 accountants, 2 accountants for this company, 2 accountants for this company. Maybe you can move to 3 accountants or whatever it may be. And I'm sorry for picking on accounting. I'm an accountant by trade, but nevertheless, there's a lot of opportunity, and that's the underlying fundamental predicate for purchasing these businesses. So understanding that as you move towards a potential sale is important, because it's important to identify those value points of value with a prospective buyer. So as it relates to the current environment and post-pandemic, once the curve is ultimately flattened, we break the back of the curve, and we have nominal cases, or we're nearing a drug that will cure any outbreak or what have you. This is what we're talking about. We're talking about today through the end of this crazy world we're living in. Notice that everything's changed. Everything I just mentioned, the underlying fundamentals, the reason why you want to buy a vacation rental business, etc. Everything's changed, and what's happening right now is the vultures are circling. We're seeing folks, clients of ours, receive emails from people saying, "Hey, I just wanted to check in on you guys. Let us know if you need any help." That's code for, we think you are in trouble. we want to buy your business for pennies on the dollar, and you're going to get a lot of that going around. Now, you may be in a situation with your business where the underlying operating cash is not what you want it to be, and you may need to consider a sale. So you can do that and do it in a well orchestrated manner that will garner maximum value. But the thing you don't want to do is hop on the first train that pulls into the station. And what I'm specifically talking about is someone who feels like they have leverage over you, because all inquiries really should be approached with professional skepticism. I heard a quote recently from a friend of mine whereby he mentioned that a rising tide lifts all boats, but a receding tide is gonna tend to beach the heaviest boats first. So be mindful of national and large regional companies coming by and saying, hey, I want to buy your business, I want to do this. In a lot of cases, those businesses are not architectured to move right now. I don't know any of them that frankly are in the purchase and sale. I mean, they're not looking for M&A, at least not in the traditional sense. What they're trying to do is frankly absorb your contracts. They're trying to put you in a position where they say, hey, listen, there won't be any money up front, but what we can do is absolve you from the liability. And I think, in certain cases, that may feel like the right way to go, but if you have something of value, you need to be paid for it. You need to receive consideration for something of value. And frankly, I think if you run your business the right way, even if you are short on cash, there are measures that you can put into place. We could help you do that to help you bridge this gap and get to a point where you're either back on track or you can sell your business for exponentially more. If you're solicited directly, your business is being perceived as vulnerable, right? People that are knocking on your door during a pandemic are saying, hey, listen, I perceive that your business is having issues. So it should give you a bit of a pause, and pause for concern. Moving forward is going to require you to be very diligent and consider the pathway moving forward. You're looking at an environment that's not going to be the same for the next 12 to 24 months. And Ben, people say, Ben, now listen, hey, we're going to be back to normal in June or July. Yeah, maybe so, but I can promise you, that a cross section of the traveling public is not going to travel until they can take a pill and knock this thing out. Folks like my mother or folks 55 and up that have an underlying health condition, what have you, are not going to get on a plane and fly 9 hours here. They're not going to come to a crowded area there until they have reasonable certainty that if they can't contract the virus, that a pill will knock it out like a Z-Pack in a few days. I just don't think we're going to be fully back to normal. And I think what's going to happen is you're going to see diminished rate and diminished occupancy through 2020. I'm hopeful that our comeback year will be 2021, but you're really looking to as far as exiting the business, you need a good 12-month period of reasonable earnings on the upswing as compared to the earnings to the pandemic to be able to show something. You've got to show a prospective buyer that your business is trending up. With all that being said, you may not have an option, and if you don't have an option, or you're really not feeling this next 6 to 12 month process. I mean, it's going to be a tough process. I mean, let's be honest. We're going to have to work through a number of things and run the business a different way. We're going to have to work harder for less money. So if you're considering an exit, you may want to consider these pitfalls before you move forward. I'm going to make a quick change here to my side so that I can see a little bit better. All right. Perfect. So we're going to want to consider the fact that you know you're going to be solicited. We've already explained, espoused that the vultures are circling. Everybody's going to be knocking on your door. They're going to be explaining to you that, oh, we've been admiring your business for years and years and years. Guess what? Everybody's giving the same pitch. So understand that. So when that happens, you know, you need to explain to folks out there that you know, you're not going to have a casual conversation. And the way you do that is you treat any and all interest in a business-like manner. If somebody calls and wants to casually talk about your business over the phone, I think that's really unprofessional. I think that should give you insight into how they do business. And I think some of those folks right now that have done business that way are really, I think they're in a position, frankly, where they're not, you know, they're obviously not doing deals, but I also have heard that they're not making payments on the deals that they've recently purchased, and so there's a number of things that you need to consider moving forward. And I think that's a really telltale sign in starting this discussion as insofar as how someone treats you on the front end. If they want to be really casual and try to get some information, try to get you to overshare on the front end, kind of pre-negotiate on the front end without anything tangible or material or legal in front of you, I think that should give you an idea of kind of what you can expect on the back end, because what I'm hearing on the back end right now are some horror stories. I think the way you explain this is that everything you have is for sale. I've been approached on a number of my businesses, and I explain to folks that everything I have is for sale. That includes a 4- and 6-year-old some days of the week. If you'd like to speak to me more seriously, let's execute a non-disclosure agreement, right? Let's get a non-disclosure agreement going. And if that runs somebody off, then that should explain to you their fundamental intent. Aggressive solicitation tactics are unprofessional. Don't do a deal with somebody who's pushing you. You don't need to be pushed into a deal. The deal should be straightforward. It should be professional. It should be formal. And you want to engage with qualified parties. You know, don't just pick up the phone if you don't know somebody and they say, hey, my name is so and so. I want to talk to you about, so well, wait a minute, I don't even know who you are. That's okay. Explain to them how you treat your business in a more formal manner. And frankly, I mean, they should respect you for that. So engage with qualified parties on the front end. Understand that everybody's received the same, solicitation letter, same telephone call. I talk to people who say, well, I was just really flattered. I was really, really flattered they reached out to me. I'm like, you knucklehead, you goofball. They've reached out to everybody. You're not special. Everybody's been reached out to 5 times right now. The fact that you're just getting called means that you're on the bottom of the list. I said it jokingly, but that's really what happens. Don't feel flattered. They're just combing through. They're just farming, right? They're just farming the field. At the end of the day, you want to engage with a party that actually wants your business. Wants your business. Keep in mind your business, not a business. That's important because somebody who wants your business sees that as a strategic opportunity is really important. So I would tell you, as you move forward with this process, whether it's Weatherby Consulting or your accountant or your attorney or someone, find someone who understands the vacation rental business in and out, understands M&A activity, understands deal terms in the vacation rental business, right? Because if you go into a deal, you don't know what's a good deal, what's a bad deal, right? Because what you're going to be relying on is the buyer dictating terms to you. And in a lot of cases, folks are really paying the price for that right now. We've been preaching that for years. If you go into a transaction without being represented or properly represented, you're going to be relying on the buyer to dictate terms, right? And that's the worst position you can be in. And we'll tell you why in a few more minutes. So we want to utilize an advisor because you're going to get increased value. Whatever fee you pay them, you're going to make it exponentially more on top of the deal. They will get you more money than you would be able to get yourself. you're going to have a successful closing because they take the emotion out of it. They're driving to all the diligence that's required, all of the information requests. They're able to answer questions on your behalf and keep you out of the fray and keep you from getting frustrated. They're going to make sure that you have a qualified seller, qualified buyer, but you're qualified as it relates to preparing the information. So, couple of things there. We want the qualified buyer, but you as the seller also need to be in a position where you're disseminating professional information and not giving information out that is not representative of the business, that the business is portrayed in an accurate light and not in a poor light. In that same vein, when you disseminate information, you being qualified, you disseminating information, it also avoids some misrepresentation. So as we move on, we mentioned this earlier. We don't want you to pass go. We don't want you to collect $200 without having an executed non-disclosure agreement. This is pretty straightforward. The key term in this is the fact that you don't have to read this, but look at the bracket A, bracket B, bracket C. You shall not induce any property owner. You shall not request or advise any property owner to withdraw. You're not going to disclose. You're not going to attempt to induce your employee or agent of the disclosing party to leave. Any statement, non-disparagement. I mean, this is really fundamental stuff. And if somebody says, oh well, we do a lot of solicitation in that marketplace. We can't, and we blanket solicit, the entire marketplace. You really need to consider doing business with that person. If someone can't agree not to induce any property owner to leave, right? And if they come back and say, hey, listen, we can't do that because we solicit everybody in Destin, Florida, everybody, right? Well, okay, maybe we can work with some language. How about directly induce? You continue to solicit, if you want to, you don't know who's on our program, like that's the response. I don't know who's on your program, right? We don't have that information. So what if one of your homeowners call us? Well, here's the deal. How about directly induce? How about if one of our owners calls you, then your response is, well, we're not in a position to take your property on right now. If they can't get their head around not taking one of your homeowners, one of your employees, disparaging your business, then you don't need to move forward. You fundamentally don't need to move forward. It's not, you're not starting off on the right track. But this is information that you can copy and paste. We've got a lot of good agreements, and we use different agreements for different people. So there's some important points there, but this is fantastic to use moving forward. The third pitfall in this process is you don't understand the value of your business, so you don't know if you're getting a lowball offer or a reasonable offer or just if someone's trying to steal your business. So value fundamentally is both quantitative, and what I mean by that is both the growth of your business and your adjusted earnings, your financials, but also there's a growth factor applied to that. And then there's qualitative, right? There's the reputation of your business. There's your fundamental organization. Do you really have an organizational structure? Do you have a professional business? And then what do your owner relationships look like, right? The owners want to be on your program. I'm really proud of our business in Monterey County. We were voted best of Monterey. We work hard to establish relationships with our homeowners. We treat them as partners. I mean, these folks are highly intelligent, successful people. If you've got a second home in Monterey County, you're doing something right. So we treat you accordingly, and we really try to maintain their home, their property, as if it was ours. So we're focused in on that. So value is one of two things. When someone says, hey, I just need you to send me some revenue reports and I'll tell you what your business is worth, that should also kind of tell you something relative to what they're looking for in your business. when they don't ask you about your employees, your owners, what is your reputation in the marketplace? Are you perceived to be a strong company? Here's the fundamental foundation you've created. When they just care about your revenue, at least through this process, you need to be, your antennas need to go up. I'm not saying don't move forward. I'm just saying your antennas need to go up. Fundamentally, what we're getting to is you need to understand the valuation process. And in a normal market, deals would happen between 4 and 5 times earnings. Right now, I think we're going to see, really 3 to 4 times earnings, maybe 2 to 4 times earnings. I don't know, because a lot of these businesses have been wounded right now. I think you've got issues in the business, and it's going to require additional cash to fund the operation. And I think it's going to be taken out of the purchase price. So I think you need to be ready for that. And frankly, a 3 times earnings deal may not be bad, and we'll talk about that a little bit, and I'll explain why. But you need to make sure the valuation process is not clear, because if it's not, you don't know how to increase the value or accentuate the value in the process, right? So if my valuation process is all smoke and mirrors, you don't know how to accentuate to me the things that are valuable to me. And that's part of that whole smoke and mirror game where folks say, well, just give me a couple of reports and we're going to mash them all together and say, here's your valuation, right? You're not susceptible at that point to being increased. I can't say, well, hey, I don't think you're valuing this properly, right? Frankly, there's no argument on my end. And from a buyer's perspective, it's really smart, right, to mask some of that information. And I just want to make sure that you don't get I don't want to say fooled, but don't get snowed in the process. You need to understand a clear valuation process. And as we move forward, you also need to understand that you're going to have, if you take the trailing 12 months, let's take February 2020 back to March 2019. That's a pretty fair slice, right? Everybody should have good earnings during that time. Maybe you started getting some of the aftershocks of some of the first COVID information. Maybe you should go January of 20 back to February of 19. But that's a solid slice of your business. So use that slice when valuing the business, and know that buyers can't have it both ways. They either are going to take your reduced earnings, right? So if I'm selling my business, I'm going to take the end of March 2020, and I'm going to go back to April 19. So there's downturn built into that 12-month period, right? And then you should get a higher multiple on that. Okay, higher multiple if you've baked some of the risk, some of the downturn into your earnings. If you're going to present the stable earnings that we talked about, in that 12-month period, then you should expect a lower multiple, right? Maybe the multiple is lower because they do have to bake in some risk. There is some risk associated with doing one of these deals, but you can't have it both ways. You can't take numbers, okay, that have COVID losses in them and be applied a low discount multiple. Not fair, not reasonable. You should keep your business. So use the trailing 12 months, excluding March. Most of us have some losses in March, and go from March 2019 to February 2020. I think it's fair to value the business in that light, and then negotiate the multiple. Don't negotiate those numbers, because those numbers are solid. That's what your business could be doing, and I think that's a fair negotiating point. Moving forward, it's important to understand the transaction process. These guys are going to be knocking on your door, telling you, frankly, anybody that tells you, yes to all your questions at the front, expect to, in front end of the discussion, expect to be disappointed. Expect to be disappointed. Most of these folks say, oh, cash at closing, yeah, we can do that. 5 times earnings, yeah, we can do that. We can do whatever you want, right? But what happens is you get over into the transaction, you get excited about the deal. They know that you're excited about the deal, and then they change the terms. but change the terms. So understanding the transaction process is imperative. You need to know that it should be clear and regimented. There should be no surprises. You should know that this variable risk, this contingent risk, I'll pay you a couple of years from now based upon whatever metric we agree on, that's not an option, guys. It's not an option. It's not fair. It's not reasonable. There are too many people out there that would buy your business on a straight deal. You don't have to do it. You don't have to do it. We've done plenty of deals. We do not do these variable risk deals. And frankly, I've walked away from, I'd say conservatively 4 to 6, 6 to 8 transactions in advising someone where I said, hey, listen, this is not a good deal. We don't want to be a part of this. And either the deals ultimately end up blowing up, or fortunately, only a few of them have closed. And frankly, in a couple of cases, folks have had issues and fundamentally just don't get what they bargained for on the front end, right? As you move forward through this process, having an articulated, a well-defined package is important. And you want to make sure that you sanitize all the information, because all the buyer's looking for is to tell you how many dents are in the car, they're kicking the tires and the tires look bald, the engine doesn't sound right. They're going to tell you everything that's wrong. You need to pull together a package, right? You need to sanitize it. Don't include, your family recipe, a secret family recipe in there, but give them enough information to view the business in a positive light. They need to understand what your business can do. And prior to executing a letter of intent, fundamental details should be avoided. If somebody says, hey, I want to see a payroll register, well, you can see a payroll register once you're making an offer. I'm not going to share my employee data prior to you making an offer. I'm okay like confirming numbers and things like that, but you don't need to give them, again, your trade secrets. You don't give them owner names, property names, information. Block all the stuff out. If somebody says, hey, I want to see some revenue reports, it's fine. Yeah, you can show them that you've got 100 properties. You can show 100 lines in the report and what those individual properties do, but don't show the number of bedrooms, don't show the number of bathrooms, don't show them any identification that would allow them to say, the $72,000 gross you did on this home is the Edwards home, right? You don't show that information, right? You redact all that at this point. No detailed payroll information we talked about. We're only wanting you to send enough information or developing enough information to generate an offer. That's where we are. And then at the offer point, then they're allowed to dive into the business, right? Then they're allowed to do that. These offers and letters of intent should be reviewed by an attorney. You want to make sure that you are not getting tied up and forced to do something you don't want to do. All offers should remain static unless there's a material change in the business, right? If someone finds that there's a material unknowingly misstated earnings, or there's an issue here or there, that's reasonable. But if somebody tries to change the deal, fundamentally change the deal, after they've made an offer, it's time to walk. It's time to go, right? That is not good business. Retrades are, if you do it once, you can expect to be disappointed moving forward. Moving forward, if you're not prepared and not planning on this, there's a number of common mistakes, right? And right now you may not be prepared, but having an advisor, having someone to hold your hand through this process, lead you down the purchase and sale pathway, will help you avoid some of those mistakes. But preparing your business and having that advisor is going to lead to increased value. It's going to lead to that successful closing. You may also want to consider, a number of other items as you move forward. Now is probably not the time to make changes to your assignment clause in your contract. You want the ability to assign. If your agreement is silent as to assignment, that's okay. It doesn't prohibit you assigning the agreement, but in a lot of cases, the death sentence for a transaction is requiring written consent from a homeowner. That's going to force a buyer to buy the stock of a business, and not many people really want to buy the stock. That being said, consider your assignment clause. If you're curious about that, reach out to us. We're happy to help and share some information on that. You need to also start looking at your financials. You need to think about how your financials are going to be portrayed if you disseminate them to a prospective buyer. Are you presenting a house that's in order, or a house that that's in disarray? You need to consider these reduced earnings moving forward, right? I'm talking with some folks right now, and I said, hey, listen, I think your business is worth X. And they're like, well, that's not really what we were expecting. And I totally get that. What they're expecting is, probably 4.5 times earnings for 2019. And let's say, for the sake of example, that's $1 million. But if they can get $600,000 or $700,000 right now for the business, that's probably not a bad day's work. Considering the fact that they're looking at 12 to 18 months to work out of this, and they wanted to be out of the business in the next few years anyway. I mean, there's a number of opportunities out there, and cash in hand today is certainly worth more than a little bit more later on. So there's things to consider, and you also want to consider life after the sale. I mean, what are you going to do, right? Health insurance, cars, country club memberships, paid vacation, all this stuff's running through the business. And what happens when you have buildings and leases and things like that right now? I mean, what do you do with that? Orchestrating a lease with a party, in a pandemic situation, is something that's going to require diligence and focus in making sure that you actually get your money on some of this stuff, right? In a lot of cases, I've got sellers who have the buyers asking for rent abatements for 90 days. So understanding that process, making sure that you don't have any Section 1245 depreciation recapture if you're doing an asset sale, very important. If you're depreciating assets, you can get hit back, from hit from the government. The IRS is going to hit you and charge back some of that depreciation you've written off to mitigate your taxes, right? Think about the transition, and how that works, and if that's important to you, to be a part of it or not. And ultimately, I think you want to be there because you want the business to be successful. Moving on, in a post-pandemic world, I know everybody wants cash at closing, but it's not going to happen, guys. No one's going to write checks, and if they do, it's going to be for probably 10, 20 cents on the dollar, right? I think you need to find a credit-worthy, qualified buyer. You need to focus in on a good price for the business. You're not going to get a great price for the business right now, but getting a good price for the business, and moving forward, take some payments over time. From somebody that has the financial wherewithal to pay you. Look, the majority of these transactions include owner financing anyway, but normally, we would get a little bit more money down. I think right now what I'm seeing in the marketplace is folks are going to get a little bit less cash at closing. I'm not talking about 10%, but I'm not talking about 50% either. So I think it's important to know that if somebody makes you an offer with a material amount of money down, and they want to make some payments over 2, 3, 4 years, I think that's probably a reasonable deal right now. I think that's something you should consider. Before you consider, extending that credit, you need to know if this guy, this group, this company, this lady is credit worthy, and do they understand the business? Because I have so many people reach out and say, hey, we know the seller. They told us to reach out to you. We're interested in buying the business. And after spending 5 minutes with those folks, and I realized that they fundamentally have no idea how the vacation rental business works, never been in the vacation rental business. They just think it would be a fun business to be a part of. That's not someone you want to do a deal with at this point in time, right? You need someone who's battle tested, who doesn't throw their arms up when the next hurdle comes down the pipe as a result of this pandemic or what have you. You need someone who's a seasoned operator, because you want to get your money. You want that business to stay in business so you get paid, right? So it's important to know that. Knowing if a corporate guarantee is even worth anything from a buyer. And I would tell you, depending upon the business, it could be, but in certain cases it may not be. Their business may be worse off than you are. Knowing whether you as a seller are going to be in first place. There's a lot of people out there right now that are finding out that they're not the first lien holder. They're not the first mortgage holder on some of this debt that they financed. Most of these sellers that are accepting payments from larger companies are, 1,000. There's 1,000 people in front of them that are creditors. They will never see their money if that business goes bankrupt, right? And you can bang your hand down on the table. You can say, I want this, I want that. You're going to pay me my money. There's nothing you can do. Absolutely nothing you can do. You can raise your blood pressure. You can spend a bunch of money on attorneys, but you're not going to wheel them into submission and making them pay you sooner. You're going to have to take the terms that they give you. Otherwise, you're going to have to try to foreclose on the business. And good luck with that. That's going to be really difficult today.
I hate to
Yeah.
interrupt, but this point is something that I've been getting some emails about. Deals where contracts were signed where it was seller financing. I have another question at the end about earnouts. But so let's say you're in this situation right now and the person you sold the company to isn't paying you. And they're basically saying they're not planning on paying you anytime soon. You're saying there's no recourse?
I'm saying more than likely, if you didn't have an advisor and you trusted the buyer to take care of you, you more than likely don't have an assumption agreement. You probably don't have a promissory note, a guarantee, or a security interest. A security interest in those contracts. You probably didn't file a UCC-1 to foreclose on those contracts.
What is a UCC-1?
So a UCC filing allows you to in a public forum online, in a governmental setting, it extends your claim on those assets. You have a claim on those assets until you are paid in full. Having a UCC-1 filed on contracts, having security interest in those contracts is essentially what the bank does when they loan you money. They own your house, right, until it's paid off, right? They have the ability to foreclose on your house until you make that last payment. But most of these folks have some promissory note, and promissory notes are exactly what you think they are. It's a promise to pay. It's a promise to pay. And even if you have some of this stuff, you're in an exponentially better position to foreclose on those contracts, those specific contracts, if you have the security interest and you filed your UCC-1. In fact, we did a deal with a national group, large group, and in doing that, we make sure that any debtors sign off on the security interest. We gave our seller basically they're in first place. If he didn't get paid, he could foreclose on those contracts, and effectively had a pathway to take his business back. So I'm not saying there's not anything you can do, but you've got an uphill battle, and you need to talk to somebody who's going to cut through this quickly for you and not spend $5,000 of your money to tell you can't do anything. You should be able to pay somebody 5 hours at a few $100 an hour to tell you whether you've got a pathway on this stuff.
Yeah. Sorry for interrupting.
No. I'm glad you did. It's very important. I mean, we've been preaching this stuff for years, and have told people that if you're relying on a buyer to dictate terms, communicate terms to you in a deal, you can expect to be disappointed. And I've gotten some of the same emails you have. I know there's a lot of people out there that may not get, the final payment for their life's work. I mean, it's terrible when you think about it. So I think, fundamentally having an advisor, an attorney with some experience is really paramount, and it'll keep you out of harm's way. Lastly, as you move forward through this process, if your transaction becomes too risky, here's my take. Don't do the deal. Don't do the deal. I know you're excited about it. I know you want to do it. I know you're ready to be rid of it. But understand there's plenty of people out there, good, qualified people, many of which I know I've done transactions with before, that would be interested in your business. They're going to treat you with respect. They're not going to do anything that would muddy up their reputation. They're going to do business above board. If you're not dealing with one of those type people and the situation becomes too risky and you're bearing all the risk in the deal, don't do it. Increased risk can be defined as a couple of things. One, purchase price payments tied to gross rental revenue, right? Purchase price payments tied to contract retention. You should also be wary of the buyer's operating style. If the buyer has a scorched earth style of management and runs all your employees off, a third of your owners leave, you may not want to do a deal. You may not want to do a deal unless they pay you all cash at closing. All cash at closing, you can walk away, and frankly, you don't have to deal with it anymore. But you are going to run into those people in the grocery store. You're going to see them at church. You're going to see them around town. And in a lot of cases, that's happened. Where some folks have not run the business like I think they should, and they're in a position where the sellers are really, really upset that they sold to those folks. And you have to do some transactions to learn how that works. But in most cases, they're not the right people. There's too many people out there that know how to run the business as an extension of your high touch, high service, high margin, high care factor, right? There's plenty of people that want to run it that way. And I think selling it to someone who's going to chop it up and run it like a discount shop, more quantity than quality, I think you should pay attention to that. You need to know if all of your employees are going to be hired, right? I think you need to consider that, and I think that you should be notified. You should fundamentally notify your owners prior to all of this stuff, right? I think you should notify folks. You should let them know that it's coming down the pipe. Maybe almost simultaneously, but definitely employees should know. I wouldn't do anything in such a way that it could mess up your deal, but it needs to happen. It needs to happen even almost simultaneously. Maybe just prior to. But you need to communicate. Don't sit on this for days. Don't say, well, this is not something I need to share. This is something you need to do. Lastly, if someone's unwilling to prioritize the security interest, walk away. And at the end of the day, has the buyer been fair and reasonable through the process? If they tried to win every argument, right? They're not the people to do business with, right? You need someone who's going to give and take. And you shouldn't win every argument either as a seller, right? Know that. You shouldn't win every argument. So in conclusion, I really think you need to consider advisement and advice through this process. I think it's going to make you more money. It's going to keep help keep you from executing an agreement that puts you in a bad position. You need to make sure that there's confidentiality and non-solicitation in this process, because these folks are going to be knocking on 100 doors and trying to communicate with you about buying your business, you don't want them turning around communicating that to your homeowners, right? A lot of these folks will say and do anything to take your homeowners. They're less than ethical in regards to their solicitation of your homeowners. So you need to make sure you get that in writing. You need to fundamentally know your value. Now, look, your value at 12/31/2019 is going to be much different than it is at the end of April. But you need to know your value, and you need to expect some discount, because you're going to have that discount either way, right? You're going to have discounted earnings for a period of a year, and maybe that's worth a half a point in the multiple, maybe it's worth a point in the multiple, but nevertheless, you need to know your value and fundamentally understand the process. You need to prepare and plan as you move forward, and understand that financing and guarantees and security interests and turning around and filing those UCC1s back on those contracts is imperative. Do not take on too much risk. Don't do it. Don't do the deal. Don't do the deal. Folks, that's the end of the session. I'd be remiss if I didn't tell you, if we didn't have a suite of services. This is how I feed 2 kids organic food from Whole Foods. We do a lot of profitability consulting, and I can tell you that both of the businesses that I'm involved in personally are on great footing. I think if the pandemic goes for a year, then maybe I'm going to have to put some money in the business. But for the most part, we've run our businesses in a business-like manner and generated a meaningful profit. If you're concerned about moving forward through this and need some help, getting some consulting or having an operational review of your business that memorializes a pathway would be important. We're happy to help you. We're happy to give you all the advice you want. From an introductory standpoint. If you want to call and ask me questions, do it. If I miss your call, I'll call you back. We're not in the business of trying to charge you, $17 for 4 minutes of time. Listen, call me, talk to me. I've talked to literally hundreds of people over the past month, and I'm happy to point you in the right direction. If you want to sit down and talk about us setting aside time and providing services for you, that's a different deal. But feel free to call me and talk to me. If you're considering selling, or you need to sell, or you're between a rock and a hard place, call us and we will point you in the right direction. If you want to use us to help navigate that, we're happy to do it. You should not give up on your business. Those people that bury their head in the sand or the snow in these situations just create more of a mess. If you work diligently, you can work out of some of the stuff if you want to do that. And then lastly, we've got a full service accounting division. My partner in the accounting services division was the former accounting manager for Resort Quest. For 10 plus years, she was held to New York Stock Exchange standards. She was audited by Deloitte and Anderson 8 or 10 times a year. She is by far and away the single best vacation rental accountant in the industry. She's used to managing large numbers of accountants below her. And so we have a full service financial accounting team with 6 or 7 accountants below her at this point. So we're getting big. Lastly, here's my contact information. Feel free to call me on my mobile, text me. Let me know if you have any questions. I'd be happy to help you. And I'm happy to answer any questions right now.
Let me throw some questions at you really quickly. You mentioned the earnout piece of it. There are a lot of companies, not even on the vendor side too, not just property managers, who did sell with some type of performance-based earnout payment. This situation, I mean, just obviously the decline in business makes that very difficult to reach. Are those performance-based payments, or is there any consideration for this type of an event in those?
It really is it depends on the language included in the earnout. It may have an act of God provision, right? That allows a pause or what have you. But I tell you, in most cases, earnouts don't work like that. Now you may have a buyer that's reasonable, super reasonable. Says, hey, listen, I understand. We're going to wipe 2020 off. We're gonna base your earnout on 2021. But fundamentally, the majority of these earnouts, these risk contingencies, these payments where the manager has to prove themselves in order to get paid, are going to penalize them. They're going to get penalized in 2020. Some of these large vacation rental management companies are not going to give you a do-over. You know why? Because they get to pay you less. They're going to take advantage of that. Why would they put themselves in a position where they have to pay you more in the future?
Another question here is that on these funding programs, EIDL and PPP, if companies who have qualified for this support, does this affect the company's value?
That money is going into your operating account to help fund, right? To help fund payroll. And some of those advances, look at we call it the EIDL, EIDL, the EIDL advance. That money will be in your bank account for just long enough for you to see it flash on the screen, and it's going to evaporate. $10,000 is not going a long way in this pandemic. So it will go to reimburse, the seller for certain things. The PPP payments are something you're going to have to contend with, because that is a promise to pay. That is a loan. If you hire those employees back, it could, large portion of that could be waived if used for appropriate purposes. So I think that's going to kind of work itself out. Perhaps that transfers over to the prospective buyer, because they're going to have to run the business a particular way. But it can happen any number of ways, and I think that's a discussion point that we'll see play out over the next 6 weeks or so. I expect we'll be doing some transactions. We're seeing some stuff bubble up right now, and we're going to do some transactions. I would imagine a month to 30 to 60 days from now, we'll see some stuff closing.
So we've been hearing, well, when you hear that businesses are in trouble right now, what does it look like when a business is in a distressed situation that they're not going to be able to get out of?
So it means different things for different people, right? In Florida, I think you're looking at a business that has a distinct deficit in their trust account, and they might be able to bridge the gap by using those trust funds, but where they're going to go out of business is in August, right? They may be able to get through the year, but they're not going to be able to make their owner payments for July and August. So in trouble means, knowing where you stand. Now, on the other hand, let's say you're in a real estate regulated state, you can't touch your advance deposit. You're not given the ability to use those advanced funds. You may have no money in your operating account. You're basically going to die on the vine at that point. If you have no money coming in, you need to pare down. There's specific strategies for both types of businesses. You're really one or the other. You can either use your advanced deposits or you can't. And I think whether you decide to use them or you don't, or how you go about it requires consultation and mindful measurement of how you're going to run the business moving forward.
How much? I know this varies, but there's this question: how much cash should a business owner inject into the business in this case?
Look, I think I think it's probably the best question you've asked. You know, you've heard the saying, don't throw good money after bad, right?
Right.
If you can't save your business, or the business you're saving is not worth your investment, you need to consider doing something different, right? You know, both of our businesses, literally, I mean, we can live like we are right now, definitely through year end. And then we're going to require some investment in the business. You know, I know that my business in California makes X amount of money, and I'm willing to invest to maintain that. You know, I understand that, but if you're in a situation where you're just digging the hole deeper, you need to cut it off right now. You need to pick up the phone and deal with somebody that can help you navigate the process. Because what you don't want to be is in a situation where you already have $500,000 in a trust account. You put more money in, and next thing you know, 3 months from now, you have $1 million, and you don't have any way to get that. Having this conversation sooner rather than later, it's tough to do, but having that conversation sooner rather than later is really, really important. We have more options available to us when we are aware of things on the front end. But when you've exhausted all those options and there's nowhere to turn, I'm not saying we don't have anything that we can do to help you, but it just makes the process that much more difficult.
There's another question that so what is the best way for valuation if you only want to sell the hosting / management side of the business?
So the hosting / management side, I mean, if I guess I would ask you, are we talking about, you know, some type of website? Are we just trying to sell the sales apparatus? Are we selling contracts? You know, you need to have something tangible to sell. And I get into these transactions with folks that will, I've got a really good website. You know, it gets a lot of traffic. No one's going to buy your website. No one wants to buy your website. In a lot of cases, some of the national, regional guys will just forward your website to theirs. I think there's ways to sell contracts. I think there's ways to value that. But you know, generally speaking, you do that because you don't have a profitable business, or you have such a large issue in the business that prevents you from selling it as a multiple bottom line. So you're going to get discounted one way or another. So I think making sure that you really think through that process and you articulate value the right way, the way that would resonate most with that prospective buyer is important.
Well, it looks like that's what we have. But I will say that just from the people I have talked to that have sold their businesses and are not anticipating getting paid this year, I think that there's a lot of regret that they did not work, that they decided to do more on their own than maybe they should have done, and not worked with an advisor through this process. So, I mean, I certainly understand, especially in a time like this, why having that is so incredibly valuable at this point. Cliff did mention earlier in an earlier session today that he agreed with what you said, that there's not cash on the table right now, that there won't be a lot of cash up front, like some of maybe the other deals that you've closed. When you said it won't be as low as 10%, won't be as high as 50% down, is a third standard during a time like this as far as the kind of cash that you could expect to get out of a deal?
You know, we'll see moving forward. But here again, you know, if someone knocks on your door and says, "Hey, I'll take your business right now. I'll pay little to no money down," consider the people that have reached out to both you and I right now and said, "Hey, I'm not getting paid." Right? If you're not getting paid right now, you're not getting those payments after you've accepted 10 or 20% down. What that means is those buyers have bought your business for 10 or 20 cents because there's really no recourse, right? So they just sold their business for the down money. I'm not saying you can get 50%, but you shouldn't accept some low amount either. I think you've got to come to terms with an amount that's reasonable for you, and you need to know that amount needs to be satisfactory in the event somebody can't pay you. It makes me sick to hear that some of these people have worked, 5 to 25 years running these businesses, and this was their retirement, right? And they're not getting paid.
So coming up on the next session, we have Kevin Groff from US Bank, used to be at Wyndham. And he, in a phone call that we had a couple of weeks ago, he mentioned that he thought there would be some merger opportunities that came out of this. So we haven't seen a lot of true mergers among vacation rental management companies, and that would be a really good time for like-minded companies in non-competing destinations to maybe join forces. Do you think that we'll see that?
I think we're seeing it right now. Even with that happening, you've got to make sure that everybody's on equal footing in that process, and you need to know who you're getting into business with. I mean, in a couple of cases, we've made investments in the businesses and continue to do so, and are looking at doing that right now. Taking our team and partnering with someone else. I think it's a fantastic opportunity if you know what you're getting into. You got to keep in mind you've been used to running your business, calling the shots, running things through your business, doing business in a different way. And although somebody else's culture may be similar to yours, your world is going to get flipped upside down when you guys start sharing things. You have to put the business first and not treat it as a personal business. It has to be more of a commercial business. I do think that's an opportunity, and personally, that's something that we're looking at doing. We're entertaining a few different situations where we buy either a minority interest or a 1/2 interest in a business, and include it as a part of our portfolio.
There is one more question I want to throw at you, and then I will let you go. How do you differ from urban markets selling their business versus rural market businesses and vacation rental markets selling their business? It went on to say, where urban markets, I believe, have been hurting much more than traditional vacation rental destinations and the rural markets. So, I mean, it's a legit question. If you're selling an urban vacation rental business versus an urban short-term rental business versus a leisure vacation rental business, is there a difference in how you're approaching that right now?
So I would tell you, any prospective buyer out there, number one, I don't know if it's really viable for you to sell. Let me just throw that out there. And whoever asked that question, if you want to call me, we can talk and discuss the finer points. I think that's advisable, but I don't know if I would sell, because anybody who's looking at picking up inventory in an urban marketplace can just pick up the breadcrumbs from Sonder and Stay Offer and all these other people that have pulled out. I think you're better off hammering down and trying to come through the other side a stronger company than selling your business right now. I think they're just entirely. I think it would be entirely too big of a discount applied to your business to make it even remotely worthwhile.
All right, well, I will let you go. For us, we are going to take I believe we have a 30-minute break. Yeah, so grab something to eat, find a restroom, grab some coffee, because we have a really long afternoon ahead. I hope you will all join us. The next session is really talking about this, the capital available in this space right now, and I think that should be a really interesting session. But then after that, we have 3 back-to-back property management sessions. And so, Ben, will you join us for one of those at 1:45?
Absolutely. And hey, look, I'm excited to hear about the capital coming into the space. And please know that there's plenty of capital out there, right? But because there's a lot of, these people that have all the money didn't get their money by being foolish. They want to buy your business at 1 or 2 times earnings. They want to buy your business for pennies on the dollar. that, of course, there's plenty of capital, there's plenty of people that want to buy your business, but you need to strike a good deal, a reasonable deal. That's the predicate of my session today, and making sure that you end up with a deal you're happy with.
So we've got Clark Twitty later on with Scott Bunce from Cabins for You, and Josh Marquis, who, if you haven't met Josh, he's a revenue management guru. So I'm really excited to have him. And then we have Sarah Bradford and Tim Cafferty, and Michelle Hodges from Meyer. And then I'm really excited about our last session today is with 4 property managers in New Zealand and Australia, really talking about what's going on there. They feel like they're ahead of the curve from where we are right now, and kind of wanting to share what's been going on there and what they feel like the U.S. can expect to look for a little bit further down the road. So let's take a break, and I will see you back at 12:30. Thank you, Ben. Appreciate it.
Amy.